Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. You know, people invest for a lot of different reasons. Sometimes they invest for dividends or income. Some investors try to control risk. Other investors look for growth. And some look for a combination of growth income. With today's video, I'm going to cover ON Semiconductor, a technology company. And my focus with this video is strictly on growth or long-term capital appreciation. Whenever I'm looking for fairly valued stocks to invest in, regardless of my objective, the first thing I like to do is look at a long-term record of the company's operating history. And here I'm looking at operating earnings. And ON Semiconductor started out and was founded in 1999. And here you have their earnings performance. And it's not uncommon to see a company have pretty good earnings when they first go public. Then we had 3 years of negative earnings here. And then the company kind of got a little bit of traction. Of course, the recession hit and their earnings fell. But I think it's important to point out here that the company stayed profitable. And then they had some kind of, up and down earnings going into 2012. But what I really want you to focus on here from 2012 going forward, their earnings growth has really been accelerating and exceptional. If I shorten this graph, you'll see what I mean. First of all, I want you to note that their average earnings growth over their entire history has been 11.1%. However, if I shorten it just to where this acceleration happened, you can see that their earnings growth has almost doubled to 21.2%. Now, the next thing I'm going to do here is I'm going to go back to the long-term graph, and I'm going to bring monthly closing stock prices onto the graph. And what I really want you to focus on is to see how stock prices react to and track earnings. You can see a lot of volatility in the black price line. As earnings went up, the stock price tended to go up. As earnings went down, the stock price tended to go down. But since we saw this acceleration starting in 2012, I want you to notice that their earnings growth has been exceptional, and the stock returns on a $10,000 investment would have grown to $22,000 since December 31st, 2012. Now, when I shorten that to a 7-year graph, the first thing I want you to notice is their earnings growth rate now is over 21%. And I want you to also notice that the stock price is below the orange line. So at this point, I'm going to bring in another valuation reference called the normal PE ratio. Not uncommon to see with tech stocks, the market has had a tendency to value this stock at a lower valuation than its growth rate. This orange line would be a PE ratio of 21. The blue line is a PE ratio of 14, and actually 14.1, but you can see that the stock price has tracked that. And periods where the price is below that blue line have been very attractive. Periods of time when the price is touching that blue line would be fairly valued, and when the price gets above that blue line, that's less than optimal from a standpoint of purchase. And right now the stock is just slightly below the blue line. So what we have here is a very attractive investment. Now, if I simply do a what-if calculation and calculate what performance could be going out to 2019 based on estimated earnings growth here, you can see that the annualized total rate of return, which essentially is all capital appreciation because the company doesn't pay a dividend, could be as high as 23%. So let's look a little deeper into the forecasting scenario here. In order to do that, I'm going to move to the forecasting calculators here, and I'm going to start with the normal PE ratio as a calculator. I want you to notice that this company is reasonably well followed. There are 20 analysts forecasting the company to earn $1.29 for this fiscal year ending in December versus 91 cents last year. That would be a 42% increase. And some of this has to do with the fact that the company merged with Fairchild Semiconductor, which partially explains this accelerated growth. But then those same 20 analysts are forecasting growth to equal 16.28%, and then finally 20%. So, I'm using here a lower than normal PE ratio that we saw, but I can choose PE ratios, and I can go to the 14:1 PE ratio that I talked about when I looked at the historical graph, and now I can run what-if scenarios. Now, this is very important because I believe that investors should always invest with some rational expectation or idea of what they might make on a stock. I don't believe in just investing and hoping. I really try to have a very specific rate of return objective in mind. So logically speaking, if this company did grow as the analysts are forecasting, by the end of this year, the rate of return could be pretty substantial. A price gain, a capital appreciation of 18%, 18.5% from current. Now, the annualized number is bigger because you're only looking at about 5 months here. But if I go out further and assume that the company does earn $1.50 in 2018 as forecast, and it trades at a 14 PE ratio, the rate of return could be 24.6%. And then if I go out a little further and stick with that 14:1 PE ratio, as I illustrated earlier, a $10,000 investment could double over this period of time. The capital appreciation would actually be, I stand corrected, 66%. There are no dividends, but that would be a 22.75% annualized rate of return. Now, if I look even longer term and go to a different set of estimates, if I look at the 3 to 5 year trend line growth rate, there are only 4 analysts now willing to make a long-term trend line, and this is a different type of estimate. But what I want you to see here is that if this company does grow at 15 to 20% a year and trades at that normal PE ratio between 14 and 15, you can see that the double-digit rate of returns are in the cards here. This is a very interesting semiconductor stock. It's a pure growth stock. There are no dividends, but I think the key point is the valuation is attractive right now. And for those of you who are looking for some growth in your portfolio with a really good technology stock, I think you might want to take a closer look at Semiconductor. I'm going to go into their website here for just a moment to kind of give you some insights. And this is where I would start. I would get into the company's website. I would look for their investor relations department and try to understand. But this company essentially provides components that technology is built on. And I think it's a very interesting company at these levels. This has been Chuck Carnevale saying thanks for listening.